Distinguished guests, ladies and gentlemen, welcome back to our program. We will now begin this afternoon session by inviting our panelists up on stage. Please join me in welcoming Professor Catherine Lubochinsky, member of Le Cercle des Economistes, Mr. Edward Robinson, Chief Economist of the Monetary Authority of Singapore, Mr. Luiz Perreira de Silva, Deputy General Manager of the Bank for International Settlements, Dr. Mahamad Chatob Basri, former Minister of Finance of Indonesia, and Mr. Philippe HAim, Deputy Chief Executive Officer of the Société Générale. Panelists, please.
So welcome to this seventh session on finance. So the 30 years up to the last financial crisis have been characterized, let's say, by some overconfidence in finance and in market discipline. As Henry Paulson, who was then the Secretary of the US Treasury, said in a speech in Beijing in August 2007, some problems are perceptible in the housing market and the subprime loans, but they're mostly under control. Unfortunately, I don't think it was really the case. But the crisis that followed was not the first crisis either. I mean, according to works from the IMF, from Levin and Valencia, we've had about 150 systemic banking crises in the world between 1970 and 2017. And those systemic banking crises were often followed by sovereign debt crises, we've heard about it also in Europe, and currency crises. So, of course, the 10 years that followed the Great Crisis, as we call it now, major improvements have been made in terms of regulation, more specifically maybe for banks than other financial institutions, but hopefully we have improved bank resiliency and financial stability, and you've all heard of more capital ratio for banks, better liquidity ratios, reinforced supervision, systemic institution, recovery resolution plans, etc., etc. So at first sight, maybe we could relax, as Mr. Paulson did, or maybe all this new regulation is not enough to improve financial stability. This is what we're going to talk about now. So our first speaker is Mr. Luiz Perreira da Silva, Deputy General Manager of the BIS, but prior to this he was Deputy Governor of the Central Bank in Brazil, and prior to that worked in the World Bank, North America, Japan, South Africa. Well, in short, we have a global gentleman to talk about global financial regulation, and probably he'll tell us if we should have confidence in this new regulation, and if those international standards are appropriate when countries have different models in terms of financing their economies, market-based, bank-based, non-bank-based, and maybe how proactive is BIS regulation regarding to innovation. Please, the floor is yours.
Merci beaucoup, Catherine. I think I am a global citizen, but I'm Brazilian too. The last time we were overconfident in football about something, we ended up losing 7-1 to another team. You may remember that. So overconfidence is not welcome. I think, if anything, the global or the last financial crisis, which was initiated in the US but became quickly global, if anything, it tells us that if you want to ensure economic and, of course, social stability anywhere, you need to ensure financial stability. It's a necessary, not sufficient condition. And in order to achieve that, I think the regulatory framework that has been worked out by countries after the crisis is a good starting point. I think you need at least two things. You need first to ensure or to strengthen the resilience of a domestic financial system. And the second thing, you need to ensure that it doesn't behave in an excessive pro-cyclical way. So first, in order to ensure the resilience of your domestic financial system, you said it, Catherine, you need some basic common types of regulation. You need to ensure that the system is resilient to shocks, to crises, and therefore for that, you need a system that is well capitalized and of capital of good quality. You need a system that holds enough liquid assets to resist episodes of fire sales and shortage of liquidity. And you need also a system that is not excessively leveraged, meaning that the level of debt vis-à-vis the resources of the system is not excessive. And roughly speaking, what has been lessons of this crisis, what has been discussed is robust, is been implemented. It is called now the set of rules under Basel III, the set of rules that have been agreed upon by all the major countries and major financial center, and this has been is being implemented and is a strong and good starting point. There are, of course, some additional elements that you need to pay attention to, which is the volatility of capital flows, and this is something that particularly affects emerging markets. Despite the resilience of your domestic system, you could have episodes and surges of rapid movements of flows, which, as you can easily understand, also triggers the volatility of exchange rates, and that affects countries that are recipient of these flows. So despite the fact that you can ensure that your domestic system is robust and strong thanks to capital, to liquidity, and low leverage, it can be affected by these more sudden outbursts of movement of flows, and you need to sort of ensure that you are also responsible and protected, running good policies to be able to resist these sort of sudden floods of capital, which can be accompanied also by sudden shortages of these same floods. And in order to do that, one good element of the framework that Basel has put in place is to try to avoid that the system becomes excessively pro-cyclical. Now, we know that the propensity of finance from good literature, think of the rational exuberance, think of the way in which the system has this propensity of generate asset price bubbles, has the natural propensity to become pro-cyclical, meaning that people don't necessarily measure the right moment in which the system has built up vulnerabilities and risks. So one of the good things about Basel III is the installation of what is called now a set of macroprudential rules, which are also a second way to avoid excessive build-up of procyclicality in the system, which is, if you wish, a bit of sand in the wheels in the functioning of the system. You try to build up capital when the moments of exuberance kick in your financial system, so that you try to slow down the way in which the system becomes more leveraged, and you can release these buffers in bad times. So in a way, you attempt to have a system that is more resilient, more capitalized, liquid enough, and not excessively leveraged, and you try also, in order to ensure financial stability, to make sure that your system is not excessively pro-cyclical. So that's the sort of general guideline that is being constructed under Basel III. And of course, now the application and implementation is the result of country-level legislation, but hopefully with the lessons of the crisis, and with these caveats that you need carefully to monitor the behavior of the system, we can hope that with these cares, the financial system will learn lessons from the Great Crisis and will ensure, with more stability, that you can work towards social inclusion and towards economic stability. I have also another observation about innovation, but I leave it for the next round, Catherine.
Okay, thank you very much. Well, that's already food for thought. Yesterday morning, Minister Chan asked whether politics will defeat economists. I think our next speaker maybe can answer this question, as Mr. Mohammed Basri is the former Minister of Finance of Indonesia, but also now he's the chairman of advisory board of the Mandiri Institution, which is the think tank of the Bank Mandiri, the largest bank of Indonesia, right? And he's also the chairman of Indonesia Infrastructure Finance. Now, for maybe some of you who might not be too familiar, Indonesia has also experienced a major systemic crisis in 97, 98, which was one of the costliest in the world, because I think you've used something like 50% of GDP to bail out banks. So what is your view on efficiency of the regulation nowadays, and do you think that you can avoid such new big crises?
Thank you very much. It's a great pleasure to be here. Let me start by saying that it is very unfortunate that we cannot really predict the financial crisis, you know. Like in my case, we have this Financial Stability Forum meeting every quarter, and you can see all the indicators are in the good shape. But all of a sudden, you can be in the financial crisis, right? So let me give an example. Luiz mentioned in his remarks regarding this volatility of capital flows. So let me share my experience when I had to manage the taper tantrum in 2013. Indonesia at that time was in the good shape in the sense that the economy grew by about 6%, the second fastest growing economy among the G20. But all of a sudden, because Chairman Bernanke at that time, during his testimony in Congress, made a statement to end the tapering purchase, and all the emerging market, you know, affected by that. Yeah, I'm not blaming it simply because there's this statement made by the Chair Bernanke, because the problem with the emerging market is also about this current account deficit. Yeah, one thing that I would like to highlight here, I completely agree with Deputy Prime Minister Tharman as a chairman of the EPG when he said that having a current account deficit is not a sin. It is true. Having a current account deficit is not a sin, but a punishable. Because nowadays, if you run a current account deficit more than 3%, then the investor, you know, will leave the country. If your current account deficit financed through the portfolio, then you are in trouble. So, you know, one country like Indonesia, we are in a good shape because the sort of like, you know, like what happened last year, the normalization of monetary policy, and then we are run a current account deficit 2.5, the market left us. So the issue of volatility of capital flows is a very important issue to be addressed because it may have an impact on the credit crunch, the liquidity problem on the banking sector. Yeah, and I cannot entirely blame if the reaction from some emerging market, especially in ASEAN countries, they know if they have to face a problem like this pressure on the current account deficit, the balance of payment crisis, they cannot go to the IMF because the stigma issue. Yeah, even Singapore in 2008, they didn't go to the IMF when they need to get a support they went to the Fed at that time as part of these systematically important countries at that time. So that kind of regulation, a set of framework are available for us. But what I'm afraid is not enough because the policy option is not, much available for us. Let me give an example. When the Fed lowered the interest rate to 0.25%, similar like Brazil, we experience a huge appreciation of the currency. Will be very difficult for the central bank to sterilize at that time because it's very costly. If we let the exchange rate to appreciate, it's going to kill our export, right? You're going to come up with this set of this macroprudential, but how far? How, whether this macroprudential could be effective or not. So somehow, based on that experience, I think we probably need to do everything a little bit, because in the country like Indonesia, if you use the exchange rate as the only shock absorber, then we got a problem of trauma back on 1998. Every time the rupiah depreciate, people start to think the Asian financial crisis is back. Yeah. So this is a very important issue that we need to address. But I'm not saying that all the regulatory frameworks, all the regulations set the macroprudential is not useful. It's very useful. But my point is, we probably need to somehow, this is what I'm afraid, the reaction from the government in the future, or maybe the authority of the financial authority, with the risk of the sudden reversal, which is happening, maybe some countries start to think about possibility of imposing, nowadays they call it the macroprudential, but maybe in the form of the capital control. Yeah, I'm not suggesting it because in the country like Indonesia, we are adopting the open capital account, so we are not allowed to have this capital control. But maybe we can come up with the innovation. One thing that you can't find it in the textbook, what I call the reverse Tobin tax, for example. So in the Tobin tax, you tax the short-term portfolio, but you give this lower tax for the long-term investment. But in the reverse Tobin tax, perhaps you can incentivize people to stay longer. Yeah, for example, you give this double deduction for if you don't bring the repatriation of the money back outside the country. So that kind of policy, that's the first one that I would like to the highlights. The other thing, the problem with the emerging market is also the non-bank corporate external debt, because the interest rate in the country is relatively high, so they tend to borrow from overseas. So when the rupiah depreciate, there is a risk of that. Yeah, if they are not ready for this, the project is not naturally hedged, it's gonna be a problem of us. The other thing, and this is something that inevitable, common creditors. Yeah, I remember that we have a very little exposure with Argentina and Turkey. But all of a sudden, when Argentina got hit and Turkey got hit, the financial market in Indonesia also got hit. And one of the reasons is because the common creditors. Because they have the same investor who invest in Turkey, invest in Argentina. When they get hit in Argentina, they have to rebalance their portfolio. So country like Indonesia, like it or not, will have an impact, will get affected by this. So that kind of issue, that kind of information, we probably need to look at it. Unfortunately, based on my experience, the government, for example, we don't really have this information into the micro detail. Because if you want to know who are our bondholders, you need to talk to your custodian, to understand that kind of situation. So that kind of risk is there. So to be honest with you, I don't have this sort of like the full answer how to prevent this financial crisis to happen. But one thing I have to, if I could share my view here, we need to be ready at any time that the financial crisis could happen. Yeah, even one thing that my problem with the financial system, financial stability system indicators, if you look at these indicators, everything's look fine because you are using the aggregate number. But sometimes the problem in the banking crisis is started with the small banks. Yeah, all other banks, you look at the capital adequacy ratio are in place, all the indicators are in place, but because the small bank collapse, then it might create a panic in the economy. That's the reason, for example, like in 2008, even though small banks like Century collapsed, the government decided to bail out, then become a political issue. So making this political economy process become very difficult. So, you know, to end my introduction, I think one thing that I can learn from Indonesia's experience is we probably need to get ready at any time, because I don't really buy the argument that if you look at all the indicators, everything's already in place. We don't need to worry about this impact of the financial crisis, because financial crisis, the banking crisis, is always like a black swan. It could happen even when you are thinking that you are ready to face it. I stop it here. Thank you very much.
Well, we are now going to give the floor to Mr. Edward Robinson from the Monetary Authority of Singapore. He is the chief economist and the assistant managing director of the Economic Policy Group. The MAS has been at the forefront of cross-border cooperation with Asian countries. So we would like to hear about how feasible this cooperation and coordination is. And I think the Singaporeans have read Max Weber, at least his book that he wrote in 1996 on stock exchange, where he explains why international cooperation and coordination are prerequisites for any financial regulation. And then he demonstrates, and that's why I think Singapore has read it, that finance and bank capitals is as useful as guns and cannons for an economy. And why I say that is because we all know that Singapore is a major financial hub. And I will have a personal question, which is, do you have any recipe? Because now that the Brexit is about to happen, maybe sooner or later, we're all fighting in Europe to become the financial hub or the financial center. So maybe if you had a few hints for that, be useful. I would have another more specific question. That's the fact that the entire banking system in Singapore, the loan-to-deposit ratio in foreign currencies higher than 120%. Does that worry you as a regulator? Does that put you at a specific risk, which is a bit what we've been talking about earlier on? And what are the difficulties of coordinating regulation within Asian countries?
Thank you, and thanks to the organizers for having me here. Just to take a point that Basri has been emphasizing and so forth. We are acutely aware in this part of the region, and certainly in Singapore as a small open financial center, that neither emerging markets or developed markets graduate out of financial crisis or incidences of financial stress events. And I think we are acutely aware of that in policy, in our responses and so forth. So how do we prepare for that? I mean, Singapore represents, I guess, a very unique case of openness, both in to global trade, but also to financial flows. So in financial flows, for example, gross capital inflows can average as much as 1/3 of GDP in any 1 year, and that's a huge amount of capital flow to intermediate safely through the system in any given point in time. So, I mean, the financial stability is multi-pronged and needs to be tackled at many levels, starting just from the very basics, from getting the fundamentals right. And that's a whole range of factors, including making sure that your fiscal position is sound and is unencumbered. Your macroeconomic stability over the medium term is secured. There's credibility in what the central bank does and in what the Ministry of Finance does. your corporate and the financial system are endowed with an above median level of buffers, given the openness that we have, given the latent vulnerabilities that we do have, being a major financial sector and being exposed to financial shocks, and very open to the transmission of volatility of shocks from any part of the international financial system. But within the central bank, there are specific things that we need to take care of as well. And it starts from monetary policy. Price stability is very much a key component of securing financial stability over the medium term. What you need to do, signal to the markets, needs to be credible, it needs to be consistent, and so forth. And in Singapore, we have a unique setup whereby the monetary policy system is based on the exchange rate, and we manage the exchange rate within a band. Having it fluctuate within the band actually provides for a short-term shock absorber for this enormous amount of capital flows that swish around the system. But yet that the band, the policy band, the exchange rate policy band needs to be anchored to a more medium-term orientation, and that's price stability, but in itself also anchored by the fundamentals of the economy. You cannot maintain an exchange rate that is out of whack with fundamentals. That's a sure attractor of the wrong type of capital flows, the wrong type of attention in financial markets. But then going more directly into the financial system, the central bank in Singapore, the Monetary Authority of Singapore, is integrated supervisor, so covering supervision and regulations over a whole range of activities in the financial system. So there's micro supervision, and in micro prudential supervision, we are not wary of being intrusive where it needs to be. We are not wary of imposing costs and transaction costs to the financial institutions where there's good cause to be. And I think that's doing the groundwork, the micro supervision of financial institutions on an individual level, I think is really very key, and one of the basic precepts of building a strong financial system. And then beyond that, macroprudential, where we join the dots, we be a bit more careful about interlinkages. We are acutely aware of the nodes in the system, especially in the wholesale market. But we are also aware of the more macro risks that can come into the system, alert to asset price inflation, in Singapore's case, particularly the property market, but also just capital flows. We tend to be the recipient of huge amounts of capital flows as international market sentiment ebbs and flows and so forth. So you do need to have some sighting of how this flows work through the system. And then thirdly, there's a need then to try and coordinate and complement, to see micro and macro prudential measures in a complementary fashion. We all need a lot of help in ensuring financial stability. And if you have the independent instruments and so forth, bringing them together has its advantages at very significant touch points as well. So in Singapore's case, for example, one of the areas that we worry about for systemic risk reasons is the property market. There you need to look at it from a microprudential angle to make sure that concentration risks and so forth are contained. But from a macro point of view as well, the amount of credit that's going to the system and so forth, making use of loan-to-value ratios, and that sort of thing. And again, being intrusive when there's a need to, when there is market failure, when there is information asymmetry and so forth. And then finally also is marrying financial stability with macro stability. Macro stability has fiscal stability, price stability, and then financial stability. How do you bring everything together in a manner that makes sense? Luiz has done a lot of work on this conceptually and helping central banks to think in a more formal framework about such things. I wouldn't say that the MES formally integrates everything together and so forth, but we certainly at relevant touch points try and exploit the complementarity that each of that brings. Okay, coming to the specific questions that the chair has asked, so loan to deposit ratios. It's ironic because the FSEP team, the IMF Financial Stability Assessment Program team, was in Singapore to do its 5-year financial checkup earlier this year. And amongst other issues and so forth, this was flagged. So Singapore is not unusual in that respect. Many other countries do face the ratio. So, I mean, our response was that it's not a systemic issue. It is the exposure to the swap market that we watch exceedingly carefully. The bank's exposure to that. But as a system as a whole, we have established that the underlying sort of sources of foreign currency deposits and so forth are actually quite stable. But in the short term, yes, you could, in the context of significant changes in US dollar funding markets in the wholesale side, we do need to watch what happens at the short end of the swap market. A swap line with the US Fed would be helpful, but that goes beyond economics, that goes beyond finance, and sometimes it's sort of difficult to establish the considerations behind how the Americans think about such things. But Singapore is a major regional financial center and funding center, I think as a signaling mechanism and so forth would also benefit from that. It's a comment, and I think the larger issue here that we can talk about later is also about reserve currency status. It's all associated with that, the predominance of a particular currency and so forth. Now, cooperation and all that, I mean, you can't look at financial stability from a national angle and all that. You do need to look at it at particular layers, national, regional, and then global as well. And here, safety nets and the liquidity sides of things, it is difficult to stitch everything together in a very optimal way. There are considerations that each nation has in terms of its priorities, as in imperatives and so forth. There are spillover effects that we need to contend to. There are moral hazard issues. So in this sort of considerations, you do have an undersupply of safety nets in whatever levels and so forth. And there is really a shortage, I think, of sufficient coordination, sufficient goodwill, I think particularly at a global level, to complete the safety net that I think is becoming increasingly important for a world dominated by very volatile capital flows, imperfection in asset markets, short-termism in asset markets and so forth. So I think that's a very key sort of unfinished reform agenda in the national system.
Okay, thank you very much. We now have Philippe HAim, who's the Deputy CEO of Société Générale in charge of international retail banking, financial activities and insurance. But Philippe also is, I think, always very happy to come back to Singapore because he has been Deputy Trade Commissioner at the French Embassy, right? Now I will talk to the practitioner and the banker. Philippe, what's your point of view about financial regulation, banking regulation? Has it gone too far, as many banks say? Is it too complex? Or what are the loopholes or the weak links that you've spotted, and therefore worldwide, how do you do regulatory arbitrage, if you do any? Please, Philippe.
Many thanks, Catherine, many thanks. Lot of questions, lot of subjects to address. maybe the starting point would be to admit, as a banker, that it's fairly legitimate that the banking industry is regulated with scrutiny by international bodies, by central banks, by treasuries, is completely, let's say, consistent with our mission, and also the specific role we have in financing the economy and the systemic risk we represent for the financial system at large. So globally speaking, I would say that, to summarize my points, despite difficulties, we manage, when I say we, all the stakeholders, we managed to build a comprehensive framework to address systemic issues over the past 10 years. Nevertheless, down the road, we have a point of attention we need to address. So if I start by the beginning, I would say that over the past 10 years, it has been for banks, for market participants in financial markets, it has been a period of high-frequency regulation. So a lot of new rules, new frameworks being introduced, being implemented, and for many areas. So we have, of course, the setting up of the G20 after the Lehman Brothers collapse, and all those efforts to build a very broad international cooperation on a very pragmatic basis, and with very, I think, interesting fruits. For example, how to address recovery and resolution. It was very important. You have in EU a very important step, the creation of the banking union, and please be very aware of the, let's say, what it means for European countries to transfer the sovereignty of supervision to ECB. It was a significant step to transfer supervision for our own central banks to ECB. And then we have decided from that to build a banking union, so with a joint supervision, with a set of rules to address cases of recovery, resolutions, a single rule book, and so on. So it was for us, we have to comply to those new rule books to integrate the fact that we have a new one-stop shop in Frankfurt. We have spent a lot of time talking to our joint supervisory team. Then in the Basel area, in the middle of the crisis, you have, as explained by Luiz, many steps. The first one was Basel 2.5. It was in 2010, was specifically to address the issue of market risk. And then we have the Basel 3 package to better apprehend, let's say, what is at stake for financial conglomerates. And then we have the completion of Basel IV, what we call internally, but it's forbidden to say this word, Basel IV. So Basel IV being the final completion of Basel III. And just to explain simply and not to be too technical, it was about reforming the way we banks, we use internal models. And we bring more consistency in the way we calculate the capital requirements in a way that is more comparable and, let's say, more relevant from a statistical point of view. So this is, let's say, a very wide set of new regulation, and I didn't mention at EU level rules on MiFID, on market abuse, on money laundering, and so on. Just to give you a sense, at EU level, more than 40 EU directives had been adopted between 2012 and 2016, so it was a pretty massive. So overall, I think that the system, by far, is today far more robust, far more solid, and so to weather a new systemic risk. And just to give you an idea, we have increased by, at the global level, the equity, the core equity of banks in the world by roughly 60%. And we are all converging towards a core equity tier 1 ratio between the directions, the range is between 12 to 15%, and before the crisis, using the same concept, it was more in the range of 7 to 8% before the financial crisis. But those figures maybe are, let's say, difficult to apprehend because we are not talking about the same ratios. We calculate the risk-weighted asset in a far more demanding way, and the capital we compute also is more stringent. So bottom line, in the case of my institution, you have in less than 10 years, we have doubled the shareholder equity of the bank. So this is a tremendous effort we have made to comply with those new rules. Another aspect is more qualitative. A bank today is a wide machine to produce reportings. So before being deputy CEO, I was a group CFO. My job was to produce every week, every month, every quarter, gigabytes of data to ECB. So we have, let's say, the granularity was multiplied by 10, and the time frame to produce of reporting has been divided by 10. So, of course, we have the support of new technologies, big data, and so on. Conceptually, in that respect, we have to convince central bankers that correlation, in the sense that is accepted in analytics, is equivalent to accounting consistency. So we have here, let's say, a conceptual milestone to address. So we are there currently, and I think it's fair to say that the system now today, with the layers of additional capital, with the layers of liquidity, with the new concept, I didn't mention that, liquidity under stress, according to various, let's say, concepts. The fact also that we have also largely improved the governance, the way we manage banks. The system is far more efficient than it was before. So what are the points of attention down the road? The first one, obvious, and I don't want to be too long, is that we are maybe in the middle of the road regarding the banking union in Europe. So this is, I think, a very exciting project. It paves the way to maybe tomorrow in Europe, as we had in the States, consolidation. But we are halfway. So we have begun to build the house. We have the walls, but we don't have the roof yet. May I mention that nevertheless we begin to pay the house tax for that. So our yearly contribution to the Single Resolution Fund, and this is for us €500 million, so it's meaningful. So the industry is contributing to this resolution fund. But the process itself of establishing this banking union is not completed. We have not so far free circulation of capital and liquidity within the banking union. So there is, let's say, a lot of work still to be done down the road. Second point of attention: we need to be mindful of proportionality, readability, simplicity of regulation. My job when I was a group CFO was to explain to investors in Japan, here in Singapore, in Europe, or in the States, what does it mean to buy SocGen debt according to EU rules. And I can tell you that the level of complexity, when you have in front of you an investor capacity to buy EU debt, Asian debt, but within EU you have countries not being member of EU, so having specific regime, you reach a point where, let's say, the complexity is not serving the purpose. And by the way, there is something very interesting. You know, in France, our constitutional court decided, you know, there is this principle, a citizen cannot claim not to know the law. But to apply this principle, the law needs to be understandable. And he has begun to, let's say, not to validate laws that were too complex. And I think that this principle should be applied to international regulation, because sometimes only, let's say, a very small group of specialists is capable of mastering, let's say, the set of rules we have to apply. For example, Dodd-Frank, this is the American law of 20,000 pages. And the Volcker rules, you have sentences in the Dodd-Frank Act of more than 3 pages. Let's say defining a rule just by principle, so you have then to interpret and to understand what does it mean. So we have a question of proportionality, readability, simplicity of the rules. Then your last question was, do we have then a hidden spot? Of course, and this is something very important. Maybe I can mention 2. I think that today, as we have, let's say, developed a very comprehensive regulation for banks, you have now some systemic players in the non-regulated space. I think that down the road, in asset management, more broadly hedge funds, and more specifically CCP, so the clearinghouse, need to be regulated. Because we have decided that starting from the financial crisis, the execution of trades need to be centralized through clearinghouse, centralizing the counterparty risks. And you have a system of margin calls, and this system is very transparent, very efficient to mitigate counterparty risk. But what happens if a CCP fails? In fact, we could, centralize the counterparty risk in one single place. So we need to address this topic. So I stop here to leave the floor to you.
Thank you, Philippe. I'm glad you talked about CCPs because that makes the link with interconnectedness in the financial system, which is a root of systemic risk. CCPs are regulated. The problem is they're not regulated the same way around the world. There's no coordination, or there is some coordination, but there's not harmonization of the rules. As we've seen, NASDAQ almost failed a couple months ago. In Europe, we had a problem. But if you look at LCHSA in Paris, it has a bank status. So be happy it has the same kind of constraint because it is a critical institution and it's systemic also importance. So it also have the same kind of regulations you have to go through as a big bank. So be reassured about at least about the French one. So that gives the link to maybe a second quick round of with our participants. Have the roots of systemic risk disappeared? Because one was the size, remember, too big to fail, and we see that there's a trend in concentration. I mean, amongst banks, but among asset managers, it's even worse. 3 top asset managers manage $10,000 billion, 3 of them. If you look at in Germany, they're talking about merging the 2 biggest banks. So there's still a trend in concentration. Interconnections within banks have decreased because they do clear through clearinghouse. But then you have a reallocation of interconnections. I mean, it's not within banks, but banks and other institutions that are not regulated the same way. And I would also just have a question relative to cross-border independencies, who also have increased, and they are a factor of contagion. And plus anything you want to talk about, please, Luiz.
So, in a sense, it provides an opportunity to look at this question of whether we have some elements that can still create a crisis. And looking at the audience, I see a lot of skepticism in your eyes in terms of what we've been talking about here. I mean, like this amount of regulation, all these people, central bankers, regulators, bankers, talk about how the system has been made safer for you. And actually, the evidence that you have in front of your eyes is the evidence of a big financial crisis that happened. And it doesn't give you a comfort that we have improved regulation if we cannot make the system safe for you, because after all, that's what financial system is all about. It should provide financial intermediation, which should be a public good, safe, easy to access. For you, as I think it's an expression of Jean Tirole, as a common, for the common good, a public good for the common good. And have we achieved this so far? I think we are making efforts. We are learning from these crises, but we are not still yet there. Now, to answer perhaps the Minister question and give a bit of pros and cons. Have we made progress in our capacity to predict financial crisis? I think we've made some progress and I think it comes back to some of your indicators of potential risk, the degree of interconnectedness, the excessive size. We have some good early warning indicators of stress. If you have, for example, too much debt in the system, too much debt in foreign currency, obviously you are in the brink of having an episode of stress. We have also improved our capacity to stress test our financial system. The techniques have improved. The capacity to do it in a timely fashion has also improved. We have also improved, and this is discussions that we had in other sessions, regulatory frameworks and also supervision frameworks in a much more automated way. We are capable of analyzing much more data at the same time. So does it mean that with all these regulation, supervision, new indicators, new models, are we in a position to say that the system is completely crisis-proof? The answer is unfortunately not. We are, let's say, in the capacity to design in systems that are more resilient. We are hoping that the system will be less procyclical. We are hoping that some of the built-in systemic risks will fade, but still, we are not yet there. And I think there, each of us here, but also you, observing what the behavior of your banks, is important to see, to use basically common sense. Think of a medical analogy. If you are not healthy enough to exercise, to have a healthy calorie intake every day, obviously you are going to become, the probability is going to be higher that you become sick. Now, the issue that I think some of you alluded to before that, and I think, Minister, you did that, is that even if you have a very safe, healthy financial system, because of some of the characteristics of global finance, and particularly high capital mobility and high exchange rate volatility, you might not necessarily be safe. You might suffer from contagion. So you have to be ultra cautious and ultra prudent in an emerging market that is recipient of sometimes intense inflows of resources, to have your system even more robust than it should be. Now, there again, it's a trade-off between the capacity to receive safely these inflows, to translate this into your domestic financial intermediation, to make it work for your own development, to make it work for your society without incurring excessive risk. And there is no easy answer to that. You have to probably think of the way in which your own domestic policy framework is run. The safer, the more consistent in terms of macroeconomic policy your domestic system will be, the less prone to sudden outbursts and flows of capital it will be. So the less prone to what is called technically a portfolio rebalancing, which is basically investors' panic, your system will be. And this is also common sense. The domestic policy framework has to be responsible in terms of macro. There is no easy answer. This is an interaction between society and their politicians and your political economy. Obviously, finance is going to sort of exacerbate the tendency of a system to become excessively risky, or if you restrict it too much, it's going to give you subpar and suboptimal growth. So it's a very delicate equilibrium in order to protect the social construct the social welfare system that your society has managed to build so far, that you take advantage of financial integration to the extent possible with the risk that it incurs, but run robust enough macroeconomic frameworks domestically so that you don't run excessive risks in taking benefits of financial globalization. There is no easy answer. It's for each, I think, society to understand the intricacies of having the benefits of integration, and this goes for finance, but it goes also for trade, while at the same time preserving its values, its capacity to run its domestic macroeconomic policies in independence, and of course trying with that to preserve a path for a sustainable social development with the social welfare system that the society has constructed itself, usually at great pains.
Thank you. Would you like to?
Well, I think this is very good. Very well said, Luiz. I completely agree with you. I think I put the 1998 Asian financial crisis as the cutoff time. Yeah, I should say that, you know, in terms of these regulatory frameworks, there's a lot of improvement has been undertaken by many, you know, central bankers, the regulators. And I even should say that one of the reasons of Indonesia could survive during the global financial crisis, or during the taper tantrum, or even the normalization of monetary policy in the US last year, was because our financial sector is much healthier now compared to what we had in 1998. So improvement is there. We made a lot of mistake in the past regarding related to the issue of the legal lending limit, the issue of governance, you know, corruption, etc. It's been improved a lot, but it doesn't mean that we are immune to the banking crisis, the financial crisis. Let me give an example. When you mentioned about this interconnectedness, yeah, or this cross-border, we see that's improvement on this. But it's very interesting to look at the case of Indonesia in the 1998, when the IMF, the fund, closed 15 banks at a time. In terms of this share in the market, interconnectedness was pretty small. It's less than 5%. But you could see the impact not come from this interconnectedness, but through the asymmetric information. Because people at that time did not have enough information. When the fund closed the 15 banks, they did not provide the blanket guarantee. And there was a panic in the society, and there was a bank rush. Even the biggest bank in Indonesia, you know, collapsed because of that. So my point is, I completely agree with Luiz. There's been a lot of improvement since the 98 and Asian financial crisis. Then we become more careful. If you look at the, you know, all the set of regulatories proposed by BIS for the Basel, we try to comply with that. There's a lot of improvement, but as emerging market country like Indonesia, I think we still need to be very careful, because at any time this financial crisis, this banking crisis could happen. And one of the reasons is exactly what you said, because this open capital account, this volatility of capital flows, that could have an impact, yeah, because maybe one of the decision was made in advanced country or common creditors problem that could have an impact on the emerging market. Then our country, emerging market like Indonesia, we are prone to the financial instability. I remember was in the G20 meeting, Ragurajan, at the time he was the governor of Central Bank of India. He proposed something with his, of course, economists may disagree. He called about this so-called the policy coordination, but there is no such thing as a policy coordination. How do you do this policy coordination? Because related to the sovereignty. But I think it is very important if we can share the information, you know, about this monetary policy, about the fiscal policy. It is somehow each country can prepare if there is, you know, anticipation about the policy has been made in other country. Because if you look at the case of this, you know, what happened to Brexit, for example, Yeah, or what happened to China. A country like Indonesia all of a sudden can get this impact because this external situation. So that kind of issue needs to be addressed carefully as well, yeah? Not only by having this enough set of regulatory framework for the macro-prudential, the micro-prudential, we need to, always aware 24 hours, 24/7, because the potential of this shock is always there.
Would you like?
Maybe just 2 points on sort of the persistent source of risks or vulnerabilities to the financial system. One, at the risk of repeating the point, is just a reaffirmation of the risks that capital flows bring. I mean, it's an enormous tragedy and paradox of sorts, because capital or cross-border capital flows was meant to be the great force of equalization, of convergence, of raising marginal product of capital, of technology transfers and so forth. But with it, we found that imperfect markets, huge, enormous heterogeneity in asset fund managers, portfolio approaches and so forth, does lead to an excessive degree of short-termism and so forth. I mean, just to give an example, in Singapore, we ran current account deficits from 1965 to 1986, and at times it did average 7-8%, and in some years beyond 11% as well. I mean, this was in a period where capital flows and all that were a lot more tranquil, a lot more patient, a lot more equalizing, as it were. But you don't have that situation sort of anymore. We are in a second best world. And I think there's insufficient recognition that in a second best sort of Lancaster world, there is a need for intervention, for sensible intervention that brings about welfare gains. Policymakers need to be able, be accorded the latitude to make use of an optimal mix of instruments to secure the stability that their countries sort of require. Well, my second point is about the international monetary system. So a lot of emphasis in more recent discussions have been on policy responses and so forth. But the underpinnings of the international monetary system still require an enormous amount of work as well. And I alluded to it earlier. To me, one of the great unfinished jobs there is the modern variant of the, if you want to call it, the Triffin paradox, the dominance of a reserve currency that is just not internally consistent and cannot be internally consistent. And I think that there needs to be a more direct discussion about this issue, more analytical work done on that, on what its roots, causes, and so forth, and how we can nudge the system into a more sort of stable equilibrium.
On my side, a question, very important. Could we avoid new financial crisis through regulation? And two remarks there immediately. The first one is that building a common framework, I mean, a common global framework is an immense task. And I have a lot of sympathy for Luiz's team. Just to share with you that there is a philosophical tension between various regions, and to build a one-fits-all approach. So addressing all kinds of systemic risks between all those different jurisdictions is a huge task. The fact that, for example, in Europe and mainly in Asia, we are living in a highly intermediated economy, while in the US, let's say, corporates are funded directly by the market. The proportions are very simple. Banks are financing 80% of the economy in Europe, while in the US, 80% is coming from the market. So to find a common ground between all those very different places, of course, creates a lot of tensions. That's why the completion of the Basel IV package was, I think, for all negotiators, not far from a nightmare. And there are still a lot of pending questions. Is it relevant to, for example, to apply this Basel IV framework to the mortgages that are in the US managed globally by, in fact, are nationalized through Fannie Mae and Freddie Mac, so are no longer bearing the bank's balance sheet, but represent in Europe something important in our respective portfolios. So that was my first remark. Let's say it's very difficult, and we can make extra mile progress, but those progress are very difficult. Second remark, could we anticipate through regulation all kind of scenarios, all kind of situations? Can we avoid by regulation the resurgence of a new black swan? And I think I'm completely convinced that what is important is common sense and the judgment. And it's not possible to document in the regulation all possible scenarios.
Okay, well, maybe it's time to give the floor to our participants. I'm sure there are some questions. Yes, please.
I'd like to address this to the Honorable Minister
could you please give your
Okay, my name is
and
Katie
institution?
Kwok. I'm a businessman from Singapore. I travel the region, including Indonesia. And I remember to the Indonesian minister in the 1990s, when IMF imposed very strict requirements on Indonesia to get back on its feet. A calamity and crisis cannot be avoided, in my view. But once calamity and crisis have happened, should a country view IMF and other institutions as God sent, meaning the solutions are all very good? Because I understand in the case of Indonesia, the late president, he acceded to the IMF and many things followed which may not be good or that good. So could I just have the view of the Honorable Minister? Thank you.
Yes, please.
This is a very tough question. I think we have to look at this issue for more on the longer term perspective. Yeah. Some of this recommendation made by the fund was not worked properly at that time. For example, like recommendation to close the 15 banks without providing the blanket guarantee, which has created the bank rush at that time. But I should say that Indonesia entered the global financial crisis in 2008 in a better shape because a lot of reform have been done back on 1998, including the banking reform, which is require the legal lending limit, all we have to comply all the Basel regulations, etc. A lot of reform has been undertaken related to that, and I should say that the impact has been very positive to us. The second one, we abandoned the exchange rate. Yeah, we adopted the fixed exchange rate in 1998 because we adopted the flexible exchange rate. Then people accustomed to the fluctuation. So when the rupiah, fluctuate because the volatility of capital flows, people somehow accustomed to it. So no panic in the market. In addition to that, the IMF also imposed us the very strict fiscal rules. So we adopted the so-called the Maastricht rules, which is interestingly, none of the European countries adopted it. But, about the debt to GDP ratio, about the fiscal deficit. In our country, it is stipulated in our law, if the fiscal deficit to GDP go beyond the 3%, the president could be impeached. Yeah, that's the beauty to become a finance minister in Indonesia. But because of that, we were able to reduce the debt to GDP ratio from 109% to become around 24% nowadays. So I would say that in the long term, all this policy recommendation works well. But in the short term, politically is very difficult. So that is why when I met Madame Lagarde and also President came from the World Bank when I was the finance minister, I said, all of your recommendations are always good, but it probably it will take 25 years before we could implement this policy recommendation because it will always require the first-rate institution, the honest broker. With this, the emerging market, unfortunately, in the short period of time, we don't have it.
You want to add something, Luiz? Or no?
Just maybe a thought. Of course, when you run into a crisis and you are obliged to have an external assistance program, whatever it is, you have to do too quickly, perhaps, as you suggested, Minister, things that should have been done gradually. So the cost of doing this is, of course, much higher than if you had had the time to convince society to run the necessary sort of improvements in the macroeconomic setup, in the institutional and legal setup, so that you could have conducted the process without having to rush and having to pay such a heavy price. And this is, I think, the lesson that many emerging markets have learned of these repeated crises that they had in the 20th century, is that to have a sustainable fiscal monetary framework is much better to then allow you to conduct growth in a sustainable way for the benefits of your citizens.
Yes.
Good afternoon. My name is YK Tang, Singapore citizen. I like Indonesia, so no hard questions on Indonesia. For the rest of the panel, I think today is the Ides of March. And obviously to all of us, I don't see America here. Okay? I think America is leading by the back, not by the front. The next financial crisis probably will come from the United States. I don't think there will be a swap line coming to all the countries. Now, will Europe or will Asia, somebody stand up, please, and explain what's going to happen? Thank you. Sorry, it's the elephant in the room that I'm asking. It's coming.
So I think we are in the business of trying to find where the next big financial crisis will emerge from.
Probably America, one of the Wall Street banks again?
Well, let me perhaps not be so specific, but point to some, I think here we are to be optimistic, and I think I am all for being optimistic, but we have also to be fair and point to some real risks that were not examined in our conversation so far. And one additional potential risk, systemic risk for the financial sector that is not necessarily captured by the current state of regulation is how climate change might affect. Climate change was the subject of the previous panel before lunch, right? But you have, as you know, a number of potential events that can have consequences for the balance sheet of insurance, and severe consequences for the balance sheet of insurance, and also for banks. Not even to speak about the consequences for societies and populations. Now, how is this risk quantified? I think we are beginning to grasp these types of additional financial systemic risk. In our awareness, I think this was one of the results of the panel this morning, but also in the beginning of putting a price to these events. And putting a price means that you have obviously an impact on financial stability. So if you want to flag sort of a potential area where we have to work harder in terms of preserving the stability of the system, is this interconnection between what we know about the events related to climate change and their consequences in terms of financial risks, and the stability of the future financial system. This could be done, again, to come back to your question, gradually, and hopefully with long enough time to treat and to begin transforming the asset composition of our societies, the way in which we produce and we consume, from a very highly intensive carbon print towards lower carbon print, and therefore reduce this financial systemic risk, this additional financial systemic risk, or we can be hurt again by an event that would be a sudden series of events, of accidents, that will then impact in a much more abrupt way the financial system. So I hope that as because we learn from the damage that financial crisis do to the social and political equilibrium of our societies, that we are capable of learning from this. And since we know that financial consequences exist of climate change, we should be working very hard in improving our regulations and our way to shift our societies from high carbon to lower carbon print.
Okay, so from what I understand, we should integrate much more the climate risk into regulation.
This is still a step further,
okay.
But we should begin working to think about this.
Are there any other risks that you would like to think about?
Maybe to complement, and if you are at a point you are looking for a reason not to sleep, may I mention IT risk, the fact that if a major market infrastructure was not able to function, to trade treasury, hedging instruments for a long period of time, it could be very harmful for the financial system. So I think that all kind of cyber security risk or IT risk must be top of the list.
I just want to add something that we probably need to work harder on this. I'm talking from the perspective of this the Asian countries, is the regional safety net. Yeah. The question is, we do have the so-called the Chiang Mai initiative. But the problem with the Chiang Mai initiative is untested. Yeah. If the financial crisis happen, then do you think that any probably Asian countries would like to go to Chiang Mai? We got several problems. The first one, the issue of stigma related to the IMF. So many countries in Asia try to avoid the surveillance from the IMF by just look at under the linking portion of this Chiang Mai initiative, which is probably around 30% of the total quota. So country like Indonesia, or Thailand, for example, probably can draw the support probably only about $7 billion, which is not enough. Yeah. So I think we really have to work harder on this issue because this Chiang Mai initiative is untested. So I'm not really sure whether this will be a solution of the regional safety net for us. Otherwise, each Asian countries, they will go to the currency bilateral swap because it's much easier politically, rather than go to Chiang Mai initiative. But the potential is there, so we probably need to work it out.
Just 2 quick points. Well, one, to emphasize the point that you brought, which is we are putting cyber security risks and cyber attacks as among one of the tops that we need to plow a lot more resources into, as well as get financial institutions to think a lot more carefully about. So second quick point about Chiang Mai initiative, and then just to echo Basri's point, it is a difficult infrastructure here that we need to deal with. It started in 2010, 240 billion. ASEAN countries have been working quite hard on that, taking it very seriously, plowing resources into stress testing, to making it work operationally, the enormous amount of resources being put on trial tests and so forth. But as Pak Basri emphasized, I mean, that there is a difficulty, inherent difficulties in social nets, regional safety nets as well. The +3, I think, brings an additional financial heft to the system. It brings diversification and so forth. The link to the IMF and all that does play a role in signaling and establishing confidence in the adjustment that is required for a country going through an external balance crisis. But yeah, no doubts about difficulty in its acceptance.
Okay, maybe another question? No? Well, I might have one. We've been talking now about the remaining risk or the remaining known unknown risk, more or less. Any idea about unknown risks? I don't know, I'm not a specialist.
Can I don't have the answer, but I have more, this is more on the question, yeah. This is related to the innovation which has happened in the last couple of years, like digital technology, the digital currency, etc. My question is, and I don't have the answer for this, how the government or the regulators should position themselves under this kind of situation. You introduce the regulation in which the next day will be obsolete because the disruption. If you don't prevent, give a protection for the consumer, for some issues related to the financial stability, the shadow banking, then there is a risk of it. But if you introduce a policy, it might prevent the innovation. So how do you draw the line? Maybe the solution, I don't know, this is again, is more on the question rather than answer, is maybe we need to have what we call the agile bureaucracy. But unfortunately, agile bureaucracy is an oxymoron. There is no way that bureaucracy could be agile because we always work under a certain system, right? So how do we address this issue? Maybe we have to change our mindset from agree on rules to agree on principle. But if we're talking about this financial sector, financial stability, how could we sort of agree on principles than agree on rules? And I don't have the answer for this.
Maybe Luiz, you have an
Well, I think we have to work together so that finance works for the, as I was saying, for the common good. And for that, we cannot just either demonize financing too much. We have to set boundaries, we have to set regulations, parameters for its functioning, but we shouldn't, on the opposite side, think that it will solve all the problems of this world. Think of, for example, fintech and big tech. Of course, we can understand that there are many risks that are associated with the fact that it can displace labor. Technologies will certainly have a profound change the employability of even skilled workers in our modern societies. But on the other hand, these technologies can also increase the outreach of credit to poorer segments of society. It could sort of foster entrepreneurship. It could help creativity. It could help SMEs. It could even be linked, as I was suggesting, to new green technologies. So if we are capable of thinking of a finance system that can be safe, well-regulated, functioning well for you, but at the same time is capable of financing a transition towards a new pattern of growth with a lower carbon print, more green, I think we will be all better off.
But then banks would rely on third-party providers, right? And it's as safety as the weakest link. So those third-party providers should be also regulated, right? I mean, if they manage all the data, the technology, the cloud,
Yes, you will need to pay attention to the fact that, for example, today the protocols with which, and I'm sure it's another panel, another topic of discussion, in which you outsource some of the functions and the services that the financial system uses, will have to be carefully thought through. Because again, the multiplicity of tasks, the technologies that are involved, the complexity of the outsourcing processes will require certainly instruments that are more sophisticated than today. But there is, I think, overall, the purpose that all this should sort of converge towards having the system as a whole functioning in a safer way. And perhaps, again, this is my hope for this possibility of transition that I think we should aim at.
Maybe I would have a final question. I'm surprised that none of you have mentioned the debt as a major risk, because it seems to be that after each financial crisis, the debt ratios increases, especially the public debt ones, and then we see the private debt also globally increasing, if not there overall. And none of you mentioned it as a potential source of instability, because at one point...
You don't, if you consult the research at the BIS, you will see that we pay very, very much attention to the leverage of corporations, and particularly to the high level of debt in the system, particularly when you are in an environment of very cheap money, very low interest rates. This is, of course, naturally a factor of instability. However, since I am the usual economist with two hands, I just quote Philippe this morning, who was referring to the address that Olivier Blanchard made to the American Economic Association this January. There is an environment in which we have, and you can have many explanations for that, a still very low interest rate environment for quite some time, and it might last for another decade or so. Now, this might be, if we use correctly this window of opportunity, and this is, for example, propositions that are in papers and books by Brad DeLong, by Olivier Blanchard, precisely to finance at a fixed low cost some of the transition needs towards a new type of economy that will be less carbon intensive, we might be all better off. Now, it goes without saying that this is not an easy task. This is not going to happen by miracle. This will require incentive. This will require accompaniment by other policies that need to be responsibly undertaken and fiscally sustainable, but I think it's a thought, and we should all sort of examine this in good faith.
Well, then.
On our side, I mean, the debate maybe is a bit broader. I mean, apart from the issue around that, there is also the question about liquidity available in the system, and the fact that central banks' balance sheet have been multiplied by 4 during the last decades, and it creates, of course, pressure on some asset prices. And you see on some asset classes, you see some distortion that maybe are paving the way to the next crisis. So, for example, what we see on specific niche of real estate or the LBO markets in Europe, but also in the United States, clearly there is an issue.
So we should not feel relaxed, like...
Never.
Okay, fine. Well,
but we shouldn't. Look, I think everybody. This is again common sense. Nobody should feel complacent. I mean, we have so many changes.
No,
but it not to be. You don't need to shift from excessive complacency to desperation. I think there is a middle ground, and what I think we also are trying to do here in these panels and everything is to try to not to be desperate, not to be complacent, just to find the right middle of the ground, which is probably where policy should be. And we should sort of convey messages that are not complacent, not desperate, but just sort of say, look, there is some road in which you can construct our common future.
Well, on that, I'll just have one last message. I think it's a coffee break.